Financially raw, real, authentic wisdom with Lawrence Oberholzer from Retire Rich and Happy.
Good morning, everyone, and welcome to another Financially Raw. It is Thursday morning at 10 o'clock. And as per usual, I'm looking forward to spending some time with you, sharing some insights, some ideas, and some knowledge. Like our jingle says, financially raw, real, authentic wisdom. So we say it as it is. We make it simple so that you can understand. So today we're going to continue with the short-term insurance discussion. In my studio, I have our guest, Japie Venter. Hello Japie, hoe gaan het?
Good in yourself, Lawrence.
Good, thanks. Welcome. Thank you for coming in a second week. We thought we were going to get through everything. We always start the show and think, yes, I don't know if we've got enough to talk about for an hour. And then we don't even get halfway through what we wanted to say. So we decided to do a second episode, and we'll see how far we get. Maybe we'll have to do a third. Who knows? It also depends on you, our listeners, on how many questions you ask. So on that note, if you are listening and you have any questions, please give us a shout out. You are welcome to ask us any questions. Maybe you had a claim that wasn't paid out and you don't understand why. Maybe you want to know if you have a foot to stand on when you are fighting against an insurance company. I don't know. Any questions you might have, pose them to us. Japie has over 20 years experience now in short-term insurance. Yes. So if there's somebody that can tell you what you need to do or give you advice, it is Japie. So it is time for you to use this opportunity. Also, you are welcome to follow us on Facebook at Retire Happy, on Instagram, I Retire Happy, and then also on our YouTube channel, I Retire. You're also welcome to go to our website, retirehappy.co.za, and you can get hold of us on any of those channels. And all of these shows are recorded. So hello, Jock. Jock is in the studio with us as well, recording. So all of these shows are recorded and put on our YouTube channel, so you can go watch any of these recordings. If you miss something or you want to get a refresher, go back there and go and have a listen to that again. Like I said, we've got Japie Venter in studio again this morning, and we're going to continue our talk on short-term insurance. So Japie, just give us a summary. Where are we in the discussion? And then let's get going. Let's dive straight into it.
Definitely, Lawrence. Yes, I would strongly advise that the listeners who weren't able to listen to us last week catch up on the show on all the channels that you referred to. We shared some very, very interesting information concerning what exactly is insurance, how it works, why it works, and what you need to do in order to make certain that you are correctly insured. Then we had a quick discussion also about household contents. And I don't want to rehash everything we said last week. Guys, again, go and listen to the previous show. You will really benefit from it. Under the household contents part, we spoke about what exactly household contents is, how it should be insured, and the pitfalls you have to watch out for to make certain that when you do claim, you are not underinsured and your claim does get paid out.
Yeah, we actually spent quite a lot of time just on general things that people need to know about insurance. So definitely it would be worthwhile for people to just have a listen. Okay, so we've done household contents. What is next?
Next, I would like to chat about the all risk section.
Okay, maybe just start by explaining what is all risk. What is the definition?
It is a risk that covers all.
Maybe a little bit generalized.
Guys, all risks is usually defined as cover for stuff you usually take out of the house with you. So in broad spec, we would look at jewelry, we would look at cell phones, electronic equipment, laptops, all of those types of things. Now we have to realize that there's a very, very big difference between your household contents and all risk cover. Your all risk cover works on a specified basis. So where in your household contents, you just need to say, I've got contents to the value of X, and the insurance company insures you for that value. Under the all risk section, you have to specifically specify what the item is. All risks can also be divided broadly into two different areas: specified or clothing or specified all risks and unspecified all risks. Now, the wording differs from insurance company to insurance company, so check your schedule, read through your policy wording, but those are the two main areas. Difference between them would be unspecified all risks, works very much like your household contents. You are insured for a amount, and that amount covers various items. Specified all risks, like I pointed out earlier, is where you specifically specify a certain item.
Okay, so with unspecified, you've got like 10,000 Rand unspecified. Can people then claim up to 10,000 Rand for a specific thing? Or is there sub-limits to that?
That's a very, very important concept to understand. When we're talking about unspecified all risks, usually called clothing and personal effects, first off, there's a very, very big exception. Electronic equipment is not covered generally under your unspecified all risk section. So your cell phone, laptop, tablet, those types of things would not be covered under the unspecified all risk section. It needs to be more specifically specified. So what we're referring to under unspecified is jewelry, clothing you take with you when you're going on holiday, all of those general types of stuff.
Yeah.
Your wallet, and the things you usually carry around with you. There are sub-limits attached. Again, refer to your policy wording because it differs from insurance company to insurance company. But usually we're looking at a maximum of 2,000 Rand per item.
Would that include cash? If somebody gets robbed, their wallet gets robbed, and there is money in their wallet, would they be able to claim for that cash?
Not under the all risk section.
Okay.
The main reason for that is it's very, very easy for a person to say, oh, I had 3,000 Rand cash with me. And it's very difficult to disprove by the insurance company. Hence, it's a general exclusion.
No. Otherwise, everybody's going to just have cash with them anytime they lose. Or they can just say, listen, I lost my wallet and I had 2,000 Rand cash in it. I would like to claim my 2,000 Rand cashback bonus immediately, please.
Just getting back to how unspecified all risk is structured. You posed the question of 10,000 Rand cover. This would mean that as a total, you have cover up to 10,000 Rand for those general items. But your cover is limited per item to, again, 2,000 Rand.
Or whatever the sub-limit is that your specific policy states.
Correct. We always advise clients to at least take some unspecified all risk cover. It happens a lot of times that your car gets broken into, you go on holiday and you get back to your room and things are missing. Luggage goes missing when you're traveling. So unspecified all risks covers all of these things.
Sorry?
Again, when it gets to jewelry, remember the sub-limit. So you're insured for jewelry up to the limit per item.
So if you have sunglasses, everybody, the moment they get robbed or they lose something, everybody owns Ray-Ban sunglasses.
Yeah, and back in the 90s, everybody had a leather jacket as well.
That's it. So sunglasses. If your sunglasses was 4,500 Rand and it does get stolen or it does get lost, you would be able to claim up to, say, 2,000, whatever the sub-limit is, for the sunglasses. The rest is like a co-payment.
Correct.
You're going to pay the difference.
Correct. And that's, again, where we have to be cognizant of the sub-limit. Because if an item is worth more than that, then it's generally a good idea to specify that item under the specified all risk section.
When we get to things like laptops, a lot of people have their laptops specified, but a lot of people don't even take their laptops with, because these days there's more laptops being sold than there is desktops, but a lot of people don't take the laptop with. Then surely that can be included in the household goods. They don't have to specify it if it's at home the whole time.
This is probably one of the most difficult concepts for people to understand. When you're looking at the value of your household contents, you have to include the value of the all risk items, because those items are not always outside of the home. Sometimes they're inside of the home. So a claim could potentially be entertained under either one of the subjects or either one of the portions, either under household contents or under specified or unspecified all risks. Your laptop your cell phone, all of those types of things are also covered under your household contents because it was inside your home.
Yes.
If your home gets robbed and your laptop gets stolen, it would be covered under your household contents.
Okay.
Irrespective whether it was specified or not.
So if you, sorry I'm interrupting, but so if you have 40,000 rands or 50,000 rands worth of cell phones and laptops and tablets, I mean us with kids, you have cell phone upon tablet upon laptop, because every kid has a tablet and a cell phone and a laptop and all of these things. All of that has to be actually added to your household contents cover as well, although it's almost like an accelerator benefit on your household goods.
Very much so, Lawrence. And again, we have to ask ourselves the question: what is the risk associated with this item? Your own laptop, for instance, that's usually at home, especially now with these COVID times we're going through. A lot of people are working from home. Not a lot of people are going out, seeing clients, traveling around with their electronic equipment. So make the decision. If you are usually using this electronic piece of equipment at home, then remove it from your specified items. And we'll get a bit more into specified items in a minute or two. But it's covered under your household contents, like I pointed out. Kids taking cell phones to school or tablets or whatever the case might be, those things you want to specify, because they will not be covered if they are outside of your home.
Yeah. Okay, now here's a question. So I think last week we also spoke about starting to self-insure yourself, by putting some money into your reserve account or some kind of an account, and then not having to insure it on your policy. I think this is the area where most people can look at that. To start off with, that is the cell phones, the tablets, the laptops, all of that, because and you must help me with this, but the rates per 1,000 rand cover is much more expensive on these kind of things than they are on a car or household goods in general, for example.
That's very, very true. So let's have a quick rundown of specified all risks. Specified all risks would thus be any item, first off, worth more than the sublimit in your unspecified all risk items. For instance, your sunglasses. Very more specifically, electronic equipment. So we specify that item specifically. We say this is X laptop with Y serial number, and that is the replacement value. Remember, we spoke about replacement value when we spoke about household contents, the new for old basis. Yeah. Again, guys, refer back to the previous episode and listen to my explanation concerning that, because it's even more relevant when we get to specified all risks. So you specify certain items, be it your cell phone, your laptop, and maybe some jewelry. The rate on those items are extremely expensive, where with your household contents, on average, looking at about 500,000 rands worth of household contents, again subject to policy terms and conditions and underwriting, you'd look at about 700 rand, 800 rand on a monthly basis. When you're looking at specifying a laptop for 20,000 rand, you are looking at 700 to 800 rand.
Yeah.
So the rate's definitely more expensive. Along with that, the excess. Remember that portion you have to pay additionally that you are responsible for. Again, we had a discussion about this last week. Your excess is much, much higher. Again, on your cell phone, you would have a 500 to 1,000 rand excess. On your laptop, the same thing. So by specifying this item, you have not only a higher premium, you've got a higher excess compared to household contents, for instance. But the cover is much broader, because under your specified items, you are covered inside your home, outside your home. You're also covered for what they call accidental damage. So if you're sitting at a restaurant, somebody walks past and bumps your laptop and it falls on the ground and breaks, that is covered under the household, under the all risk section. It's not going to be covered under your household contents. Understand the risk, guys. Understand what you need covered. Although we said earlier, you're not taking your laptop out of the house, if you need cover for accidental damage, you have got kids and dogs running around at home, it might be worth your while to cover that under the all risk section because of the additional cover you do have.
Yeah, or just check if you have any accidental damage cover on your household contents included in there.
Again, refer to the policy wording. It's very, very important.
Okay, so we've got quite a few questions. So I'm going to run through the questions and then we can continue with the all risk. So Fricky asks, what if my bag is stolen on the beach? I then claim while I'm still on holiday and they pay out. A few days after they get some of my stuff back at the police station or lost and found. Do I keep the old items and the new ones and report it to the insurance? Because now I have the new items and some of the old items. Yeah, that's a very, very interesting scenario, Fricky. Thank you for that. So, Jopi, that's a nice curveball. I think what we need to look at there is what is supposed to happen and what happens with most people, because I think those are not the right. It's not the same thing.
Yeah, Fricky, thanks very, very much for the question. Like Lawrence pointed out, it is a bit of a curveball. If we look at how the basic principle of insurance works, there's a concept called subrogation, which basically means that the insurance company takes over your rights to an item, to a claim, in the event that you do claim with them. What this would mean is that once you've reported a claim and a claim has been paid out, then technically the insurance company owns the item that's missing. They then have the right to recover the item, to recover monies from a third party, or any way they see fit. Now, when we're referring specifically to all risk, what is supposed to happen is exactly like Fricky pointed out at the end. If that claim is paid, you have replaced your items, then if any items are recovered, you need to report that to the insurance company.
And give it back to them.
Because they are the owners of that item now. If you do not, they can potentially criminally prosecute you under terms of enrichment, because you are now in a better position than you were before the claim. That's how it's supposed to work. In reality, how does it work? Not that way.
Yeah.
Now, guys, remember, I'm not condoning this. I'm not saying, no, keep the items. Very, very, very important. It has to be reported to the insurance company. You have to then hand those items back to them, because they are the lawful owners of the items that were recovered, since you were reimbursed for the loss.
I think in practice what happens is if you do report it, a lot of the insurance companies it's going to cost us more to go and try and collect these items than just, we've already paid out for them. So yeah, technically, if you don't, you have now stolen from the insurance company and they should put in a claim against their insurance for all risk items. So I hope that answers your question, Fricky. So yes, you should report it and then let the insurance company guide you whether they want to come pick it up, or they're going to say, well, we'll pick it up and then just never contact you again. That can also happen, and I think that happens quite a bit. Okay, so we've got Warren. Warren, it's good to have you on again. So he's got a question. Hi, Lawrence and Yapi. Having worked in the insurance industry, I feel that all risk cover is a bit of a scam, because the premium you pay is based on the current replacement value of the item, which is generally quite an inflated amount and at an extremely high rate. Then come claim time, the insurance companies limits the amount you can claim, or purchases the same item, or has them created at highly reduced rates. I get that they are not there to profit, but they have taken it to the extremes. Okay, so any comments on that, Yapi?
Warren, I understand exactly where you're coming from, and thanks again for the question, and thanks for joining us this morning. Guys, it all gets back to replacement value. When we're insuring an item under the specified all risk section, it's up to you to decide how much you want to insure that item for. The insurance company does not prescribe what the value should be. We discussed in the previous show the concept of average or average. That does not apply to your all risk section. So if your cell phone is worth 10,000 Rand and you want to insure it for 7,000 Rand, You can. There's nothing stopping you. But you have to be certain that you're able to replace the item with a new similar item. When it gets to paying claims, the option is solely in the hands of the insurance company as to how they want to settle the claim. They can either do a cash payment or they can replace the item. And people are always at odds about this because they would prefer the cash, the insurance company would prefer to replace. Why? Like Warren pointed out, insurance companies have preferred suppliers with whom they do millions of rands worth of business on a monthly basis. So they generally get better premium or better rates on electronic equipment or on jewelry or whatever the case might be than the man in the street would get. So they would prefer to replace it because they can do it for cheaper.
Yeah, and at the end of the day, their job is not to replace the value, it's to put you in the same position you were in. So you had a Samsung S20 and now they've given you another Samsung S20. It's the same position you were in, whether they get it for 3,000 Rand cheaper or not. Just one thing that you mentioned, you choose. So obviously you can't go and insure your cell phone of 7,000 Rand for 20,000 Rand because again, it's about putting you in the same position. They're not going to pay you out 20,000 Rand if they could put you in the same position for 7,000 Rand.
That's very true, Lawrence. Remember, that's why we refer to replacement value. So when settling a claim under the all risk section, and most claims in actual fact, the insurance company would pay out either the maximum insured amount or the replacement value of the item, whichever is less.
Yes, obviously, insurance company always will choose the lesser one. And just to get back to self-insurance, especially with specified all risk items, let's say you have 3 cell phones and a laptop and a tablet on your specified all risk. The total value of all of these items is 50,000 Rand, but not one of the items on its own is worth more than 15. If you want to start self-insuring, how would you suggest to the listeners to do that? Would you put 15,000 Rand in for the highest value of it and have that? Because chances are very slim that all of those items will get lost at the same time. Or would you want to build up the whole 50,000 to make sure that you have enough money in reserve to cover all of those?
Lawrence, that's again a question you have to answer in conjunction with sitting and working with your wealth strategist, with your planner. What I would advise is we have to understand it's a progression. Very few people have 15,000 Rand lying around. They can just say, oh cool, now my cell phone's covered. So start off with the small stuff. Start off with saying, right, I'm going to insure my cell phone. The excess on my cell phone is 1,000 Rand as an example. So let's make certain we've got the excess covered. Because with all risks, the excess would be deducted from the amount paid out if it's a cash settlement. If it's replacement, then you physically have to pay the cash to the provider. So start off and go through the excesses under your household contents, under your all risk, under your vehicle, and put that in a reserve account first.
And then you can slowly start increasing those excesses to bring your premium down over time.
Correct. Because by doing that, you're now in a situation where you save premium, so you have more money to put into your reserve account. From there, you sit and analyze the risk. Guys, whenever I speak to clients, and you'll hear me say this a lot of times, is understand the risk. Technically, you can insure anything on the planet. I mean, you've got famous actors and models who insure their legs and their face and their ears and
some other body parts,
which we will not mention on air. So you can technically insure anything on the planet. The problem is, can you afford to do that? Very few people can afford to insure everything. So it's more important to understand the risk. Let's get back to our example of you with a laptop, kids with a laptop. Most of the time you're at home. So your laptop, move that to the household content section. Delete it from specified all risks. But the kids take the laptop out a lot. their laptops. They go to school, they go and visit friends, they use it at the university, whatever the case might be. Specify that laptop. So now we start categorizing things according to what's the risk of something happening in the event of a total loss. What's the chances of this item being a total loss? Once we've divided that up, then we can start saying, right, so my excesses are covered in my reserve account. Let's now move on to the next cheapest item. Next cheapest item would be my sunglasses for 5,000 Rand. And have that in your reserve account. And build up from there. To answer your question about how much should we have available for all risks, I would take an average and say, what are the most likely items that could go missing if we're referring to theft, that could be damaged if we're referring to accidental damage, and take an average of those. So let's call it a laptop and a cell phone. Because where the biggest difference comes in between self-insurance and specifying items is when you're self-insuring, you need not specify the item. You have 20,000 Rand available if any of the laptops go missing, if any of the cell phones are broken.
You can use that.
And you can use that. When specifying items, it has to be this specific make of laptop with that specific serial number that something happened to.
Exactly, yeah. So you'll have your own pool for specified items.
Correct.
Okay.
So to answer your question, take an average of the most expensive items and make provision for that. We answered this last time around as well. We don't want to be in a situation where we've got hundreds of thousands of rands tied up in your reserve account.
Yeah, because you want to save 1,000 Rand a month, because those hundreds of thousands of rands can generate much more income in an asset than what you're paying for it on the insurance. So we must also keep, again, go listen to that show that we did last week, because we went into quite a bit of detail on that.
Correct.
So there's another question from Velma. Hi, Velma. So if jewelry is in a safe, not worn every day, do you specify? And then what about Kruger Rands?
This is a whole other quagmire we have to understand. Under your household contents, expensive items like jewelry, there's usually a clause that says it has to be kept in a locked safe. So make certain any valuable items, and when I'm referring to valuable items, I'm referring to Rand value replacement. I'll get to why I'm emphasizing that right now. So those items need to be in a safe, and it will be covered under your household contents. Remember, the value your household contents is insured for needs to include that. So if you have a ring which your loving husband bought for you, which is valued at 100,000 Rand, you can't possibly just insure your household contents for 300,000 Rand. You're going to be underinsured.
Exactly, yeah.
We pointed out your all risk items needs to be added to your household contents when looking at insured value. The same thing applies with Kruger Rands or any type of jewelry or valuable item. It's always best to keep those things locked up, since most insurance companies have a type of clause stating it needs to be kept in a locked safe.
Yeah.
Now,
but make sure that it is part of your household contents value.
If it's an item you do not wear on a usual basis, I mean, very few people in South Africa, we do stay in South Africa, would walk around with jewelry to the value of 100 to 200,000 Rand. It's usually kept in a safe somewhere. They wear it on very, very, very extremely special occasions.
Yeah.
So leave it under household contents, because insuring that under specified all risk is going to cost you an arm and a leg. Probably both arms and both legs. It's extremely expensive.
Yeah.
But we have to understand the difference between the actual Rand value and emotional value. An insurance company can replace an item based on the actual cost of replacing it.
Yeah, not the sentimental value.
They can't replace the emotional or sentimental value of an item.
Yeah.
The fact that this wedding ring was passed down from your great-grandmother to your grandmother to your mother to you, you're saving it for your daughter. If you value it in Rand value, you take it to a jeweler, it's going to be valued at 5,000 Rand. That's the replacement value. So if that ring gets stolen or it gets lost, the insurance company is going to pay out 5,000 Rand minus your excess.
Yeah.
It's not going to replace the ring.
Yeah, it can't. So you can't insure sentimental value, unfortunately.
Which, just quickly, Lawrence, on that subject, a lot of the times, especially with jewelry, the insurance company would ask for a valuation certificate to prove, first off, what the actual value is, and to add in the description a description of the item to make it easier to replace should something happen to this item.
Here's an interesting question. So you do have a necklace. Necklace is worth 150,000 Rand. You only wear it once a year to the end of year function, the ball you have at work. Do you take that? It's part of your household goods. It's pointless to put it into specified all risk. But if you do wear it that evening, so in December you're going to wear it, would you add it to your insurance for that month?
That's an extremely tricky question.
I know.
Looking at it from the insurance company's view, short-term insurance is not temporary insurance. Short-term insurance companies don't like you putting on an item and then telling them, I'm just going to wear it for tonight, because they would charge you 1,000 Rand to insure that necklace, as
for
an
one
example.
night, yeah.
In the event that something does happen to that necklace, they have to pay out 150,000 Rand. It just doesn't make economic sense. So if you approach your insurance company and tell them, listen, I'm going to be wearing this necklace tonight, please specify it for me and take it off tomorrow. They are going to have red lights flashing and saying, no, we can't do this, and all of those items. That's said and done. There is nothing in the rules of an insurance company saying you cannot add an item and remove an item. So technically, you could phone up an insurance company, say, I would like to add this item, please. And a week later, phone them and say, please delete this item. Please remove it from my insurance. There's nothing stopping you from doing it.
Yeah.
They do look at trends. If you do this every second month, then they're going to start asking questions, and they could refuse to insure an item.
Yeah. Okay. But if it's like a once a year, like my analogy, it's only in December, they probably won't pick it up if it's once a year for a month.
Again,
kind of thing.
Short-term insurance companies don't do temporary insurance, but there's nothing stopping you from adding an item and removing an item.
Okay. Nudge, nudge, wink, wink. Okay. Next question. So Ruan asks, hi Ruan, it's nice to have you online with us. I use my cameras for personal use and for business. What would be a better option for insurance? Specified all risk under your personal policy, house insurance, he says, or is it better to have a business or a commercial policy in that specific circumstance?
Ruan, thanks very much for the question. And yes, we've got a lot of clients, especially with camera equipment. And even with laptops, you use your laptop for your business or for your generating an income. Again, we have to go and look at the policy wording. And guys, unfortunately, policy wording is very seldom black or white. It's this massive grey area. So to answer your question, whenever an item is used to generate an income, it needs to be placed on a commercial or business policy.
Technically speaking, again.
Technically, that's what the rule says. That said, if you phone up an insurance company and say, I would like to take out commercial cover on just my camera and my lens, they're going to say no.
Yeah. Why?
We need to add office contents, we need to add liability, we need to add various subsections. So,
which in effect would then cost you more than just having the camera on your personal.
Because remember, guys, all risk cover is all risk cover. Whether you insure it on a personal policy or on a commercial policy, the premium is roughly the same because the risk is roughly the same. So you're not going to be saving money putting it on a commercial policy. Here's what we usually advise people to do. First off, disclose to the insurance company that you do use this camera from time to time, if we stick to the camera theme, to take photographs which you charge people for. You can then specify that on your personal policy, on your own house contents policy or risk section, up until such a time as you actually have a business. So as soon as this starts becoming your main source of income, then move over to a commercial policy, because then we can justify adding office contents, we can justify adding the all risk section, moving your vehicle over, all of those types of other sections, which is then cheaper as a combined product than it would have been on the personal lines policy.
Okay. Yeah, I think that's a very good explanation. Ruan, I hope that answers your question. Okay, so let's dive into some more questions. So Warren asks, another thought is, what about the electronic equipment that does not belong to us? i.e. laptops, phones, routers, inverters, screens, office furniture that has been provided to us from work, for example. The onus to cover those items lies with the employer, but could we take the responsibility of looking after those items whilst in our custody, for example, in our houses or in our cars? Should there be no forcible or violent entry at home, or should I not put my laptop in my boot whilst traveling? Who is responsible for covering the loss of if the insurance repudiates the claim? So I think where that question comes in is, can the company, because you have done something wrong, now the company can't claim on their commercial policy, hold you responsible for that? Interesting question.
Lawrence, there's a couple of questions
built into that one.
Into that question. So let's first start off and understand what we can insure. I mentioned earlier, you can technically insure anything. To insure an item, there has to be an actual financial loss by the person who insured the item. So I, for instance, cannot go and insure your car, because if you write off your car, I'm not going to be suffering a financial loss.
Unless I keep coming to borrow money from you.
Potentially. So first off, there has to be an actual financial loss. Secondly, you have to be the actual owner of that item. So, referring to the laptop, if you are not the owner of the laptop, or in some way or form responsible for that laptop, then you cannot insure it. So that's answering the first part of the question. Can I insure it, yes or no?
So that's the whole insurable interest. So if
Correct.
you ever hear a assessor or insurance company repudiate a claim because of insurable interest, that's basically what it is. The person who claims must have an insurable interest. They must suffer the financial loss.
The actual financial loss. That moves us to the second portion. And we are discussing short-term insurance here, so I'm not going to go too much into contracts. But I would advise that you always have some sort of contract with your employer stating who is the responsible person for this item. If the laptop or the cell phone or the car is provided by the employer, there needs to be something in writing saying who is responsible should something go wrong. What a lot of companies do is they would hold the person responsible for the excess that needs to be paid, but they will carry the burden of the insurance. Again, refer to your employer. Rather get this in writing, guys. Protect yourself. This would then also cover any potential negligence. If the laptop gets stolen or damaged because of your own negligence, who is then responsible for it? Remember, insurance companies cover accidents. So unless you actually took the laptop and beat it against the wall
because of frustration or the printer not working,
then it is still going to be covered by the insurance company. Now that brings us back to where is what insured, because items under our control is potentially covered under a liability section, which we'll get to at this rate much later. But just a quick rundown, this would mean that if, Lawrence, you come and visit me and for some obscure reason you brought your TV along because it's much nicer than mine,
or my projector,
or your projector,
that's a reasonable thing.
Correct.
That can happen.
So your projector, that's usually attached to your home cinema, so it's attached to the roof. It's not something you usually carry around.
Yeah.
It's going to be covered under your household content section. You come to my house, we are having a braai and watching the rugby, you brought the projector along. If we are then robbed or a burglary takes place at my house, then I can claim for that projector under my household contents because I was temporarily in control of this item. So it guys, it's again a grey area, but it can happen that way. If your projector was specified under the all risk section, then it wouldn't have been a problem.
Exactly. So that's what I wanted to come in there is if there's no other insurance on that projector because it wasn't on specified, so it was only on a household content. So now I don't have a claim because it was removed from my house, but it was in your care. Then you could claim in your insurance because otherwise I could sue you. Technically, that's very true. But you point out a very important thing. This would work if you do not have household contents insurance. Because otherwise you could claim under your household contents insurance for items temporarily outside of the house. Okay, so it's if I'm not insured at all.
You do not have cover at all for this item.
Okay.
Right. That brings us to the last portion of the question where Warren asked, could you just have a look at the last portion?
In our houses or cars, should there be no forcible or violent entry
Correct.
at home?
Now, that brings us to another very important thing, especially when things get stolen out of a car. Insurance companies says in their terms and conditions that any time an item gets stolen out of a car, it should be in a locked up compartment. So, if you run into a shop and you leave your laptop lying on the passenger seat,
not on the passenger's sheet.
If you leave your laptop in plain sight, somebody breaks the window and takes your laptop, the insurance company can repudiate it. It boils down to duty of care. I mean, just guys, think logically. You're inviting somebody to actually take your cell phone or your laptop.
Yes.
So in that instance, if it was kept in the boot, then it's covered.
Yeah.
Because it's a locked compartment.
So technically, again, if you do that and the insurance company's insurance is not paid out, they could technically keep you responsible for that because you didn't have duty of care.
Duty of care, correct.
And then you could potentially look at your liability cover to claim for that against your liability cover. Okay, but that we'll get into.
You could, but it gets extremely complicated as to how these different items or different subsections interact with each other. Just the last one concerning visible, forcible, violent entry or exit. We omitted to discuss this under household contents, but there's a difference between a break-in and a burglary. If somebody just walks into your house without you being there and takes items, then it's theft. This means that your payout under the insurance company or from the insurance company is going to be limited. Again, you need to take care of your items. We do stay in South Africa. But if somebody breaks in, there's a burglary. There's visible, forcible, violent entry or exit. So they kicked down the door, they broke a window, anything like that. Then you'll have cover up to the limits as previously discussed.
Okay.
So have a look at this. That said and done, we're referring to if you are not at home. A home invasion is deemed a burglary because you were still there. So if you're on your property and somebody walks in and steals something, then it's a burglary.
Yeah, and it's forcible and violent. Correct. Because they're forcing you to not act and stopping them to take your stuff.
Totally
Therefore,
correct.
It's forcible and technically viable.
Violent,
not viable. It's viable for them though. Okay, so next question. I hope that answers your question, Warren. Like I said, there's a lot of questions in that one question of yours. So Francois says, "Hi guys, a little late, but tuned in for as long as I can. Is there anything insurable that I can leave out to reduce my premium, if that makes sense. I think that comes down to what is primary and what is secondary risk cover. Like you said, focus on the most important things, the primary ones first, and then start going down to secondary. So if you want to give Francois some idea on that.
Francois, thank you again very much for the question. It's like I pointed out earlier, understand the risk. So when you're sitting down and looking at insuring any type of risk, be this short-term insurance, be this long-term insurance, irrespective, sit down and first determine what exactly is the financial impact going to be and what is going to have the biggest impact on my life as a whole. So, to use an example, you have a laptop which you use sometimes for work, but mostly to just have a computer at home. You also have a car because you are a salesperson, so you use your car to go and see clients. Sometimes you use your laptop, other times you don't. So what is more important? What is going to be the biggest financial loss? It would be your car. Yes, insuring your car is going to be more expensive, but if you don't have a means of getting to clients, then you can't generate an income at all.
Yeah.
If something happens to your laptop, you can still probably borrow a laptop from a friend. You could replace it with a smaller, cheaper laptop just for the time being. You can use your tablet.
You can go take out a contract at Vodacom.
So what would have the largest financial impact on my life, and judge from there.
Yeah. So start with those.
Yes.
So usually when I speak to clients, I say primary risk areas is your building, if you own your house, your household goods, your vehicle. Those are the primary risk areas. Those are the biggest losses. Then you start going into secondary, like specified all risk and things like your rental vehicles, your top-up covers. All of those things are added onto it, but get the core, the primary, sorted out first. I hope that answers your question. The main thing here, I think, is people need to put a little bit more effort into their short term. We tend to not want to dive into it. It's like, okay, yeah, let him put this on, and then we don't look at it again for 2 years. It is, you need to really look at it and say, are these things important? Do I still need it? Don't I need it? Can I reduce certain items? And do that on an ongoing process.
That's the most important part. It is about doing reviews on a regular basis. And that's where your financial planner will be able to assist you in making certain, in the first instance, that you are now correctly insured, all your needs are covered, your primary needs, and then review that process on an annual or biannual basis to make certain that we're still keeping track. You know how many times we follow up with people concerning a cell phone or a laptop, and they go, no, I sold that 2 years ago already.
Oh, really? Yeah, they keep paying for it.
And they just forgot to change it.
Okay, another question from Francois. He says, does adding and removing items in short succession affect your premium? I think there's two things. Firstly, does it affect your premium in the short term? And you can explain how pro rata premiums work quickly. And I think the second part of that is, will they put on like a loading? Will they start looking at it and saying, hey, you remember we had a case with a person who in his personal capacity was buying and selling cars.
Vehicles, yeah.
And then he put him on, and a week later he took him off, and then another one and another one. So we had a case like that. So if you can just give Francois a little bit of background on that.
Right, Francois, let's start off with the whole thing about proratas. What is a prorata? When insuring an item, very seldom do you start insuring that item on the first of the month. And when cancelling an item, very seldom do you cancel that item on the very last day of the month. And then we have to take debit orders into account and all of those types of things. So what would happen is, as soon as you phone up an insurance company or you let your financial advisor know, I want to add this item, the insurance company is automatically going to charge you from the date on which that item was added up until the end of the month. So for instance, if you have a cell phone you added, the premium on that is 300 Rand.
Yeah, then it's easy to do the maths.
You added that on the 10th of the month. Then at the end of the month, you're going to be paying 200 Rand extra. So your premium is going to have been increased by 300 Rand to cover the cell phone, but you'll pay a once-off additional 200 Rand to cover the time period that you were covered for. The same applies to when cancelling an item, because insurance is always paid up front. You pay at the beginning of the month for cover during the following month. So if you cancel an item on the 10th, again, the premium was 300 Rand, you cancel it on the 10th, the insurance company owes you 200 Rand. So that will be deducted from your next premium.
Okay.
So that's the basic concept of pro rata. The calculation is a bit more complicated because usually they work it on an annual basis and then work it back. But in principle, that's how it works. So will it have an effect? Definitely, because you're going to keep on paying pro ratas, and yes, you'll get a credit pro rata back, but it's going to play havoc with your finances, adding and removing items. Secondly, like I pointed out earlier when we had the discussion about the necklace, there's nothing stopping you in adding an item and removing it, but an insurance company will look at trends. You pointed out the car dealer, which we had, which every other week added a car and removed a car, and then added 3 cars and then removed 2 cars. And we picked up that trend. And now we need to have an honest, open conversation, because in the event of a claim, the insurance company could repudiate that claim. Why? Because the first question they will ask is, where's the insurable interest? Was this car actually yours?
Yes.
Was it registered in your name? Right? Now, getting that back to all risk, can you provide proof that you actually owned this item in some way, shape or form? So the insurance company will look at trends, definitely. If adding an item once a year when you go on holiday and then removing it end of January again, generally not a big problem. I don't necessarily condone it, but generally it's not a big problem. But if you start doing it every month, every 2 weeks, then they're going to start asking questions, and they could load your premium.
Yeah, so if you start taking it, putting it on the Friday and taking it off every Monday because of the weekend you're going to use it for some reason, then you're going to start picking up a problem. Hi guys, Lawrence here. Thanks for watching this video. I hope you found it informative and you got some benefit out of it. Please add in the comments any questions you might have or any other topics that you would like me to talk about. Please subscribe to our channel, hit the bell button so that you can get notified of any new videos that we post so you don't miss anything. Thanks guys, see you around.